So today we're going to talk about 4 ways that you can decrease your tax liability through investing. What's up, family? Welcome back to another episode of Financial Freedom Fastlane. The quicker you get to your dream life, the longer you get to live it. And I'm your host, George Achimpong. So this is a little bit of a different setup. I am in New York City. I'm staying at the Equinox Hotel. Believe it or not, the irony in this is we only have like a couple weeks left in the year, and this is the same hotel I recorded the very first episode of Financial Freedom Fastlane. So not the exact same hotel room, but the same hotel. Am I coach's phone? I thought something in the background. Yeah, and so it's a little bit nostalgic because the way we started the year, I think it might have been the second week of the year. And now we're in the second to last week of the year, and I'm recording this episode. So I didn't plan it this way. It's just how the universe designed it. So I'm a little bit excited. So it's been a really long day. I've had a really, really busy day. I did Angela Yee's podcast, which you'll see. Actually, I think that'll drop before this drops. It drops tomorrow as I'm recording this. What else happened today? I got some real-time testimonials for my fragrance that is available everywhere. Go to shop.melaninmoney.com. Equity, the official scent of wealth. Download, if you could put that in the show notes for the good people. It smells really good, by the way, guys. So yeah, I'm a little bit tired. Was all over New York City. Shot a really, really fun advertisement that you'll see on your timelines here soon. And so I've just giving you the best that I've got, as they say. But nonetheless, we're here and we're going to record this episode and give you some game so that we can finish the year strong. No matter how long my day was, I'm always going to be committed to making sure I can show up for you guys. All right, let's get into it. So the first one is tax deferral. So let's say that you're in a high income bracket and you want to decrease your taxable income. One of the things that you can do is you can choose to invest in tax deferred retirement vehicles like a 401k, like a traditional IRA, any typical employer-sponsored plan where the taxes are deferred. So what does that mean? That means that you get paid and then your employer is going to allow you to contribute a certain amount of money to this retirement account, and it subsequently is going to decrease your taxable income, which means you ultimately can be taxed less or will be taxed less, right? So investing in tax deferred vehicles can be great. Now, the caveat to that is that it's tax deferred, meaning that at some point in the future, i.e. when you get ready to retire, right, you're going to have to pay taxes at that time. So I always tell people to play the balancing act between decreasing your taxable income today while also planning for your tax liability tomorrow, because at the end of the day, tomorrow, right, i.e. your retirement, you're going to be on fixed income, right? And tax rates might be higher. And so sometimes it could make sense to take on that tax burden today, right, while not having to worry about it tomorrow. But nonetheless, it's still a great strategy to decrease and mitigate your tax liability in today's terms. Another tax strategy that you can take advantage of is by investing in short-term rental real estate, which will allow you to take advantage of depreciation, where you win in pocket but lose on paper. What does that mean? So what the IRS does, they have these different rules, right, to determine like, okay, well, this is the fair value or the value of a particular asset, right? And so what happens is over time, the value of that asset is going to depreciate, right? Just like a car, right? Like you bought it at this value, you have it 1 year, you have it 2 years, the valuable life of that is going to continue to decrease, right? So when you have a short-term rental property, and there are, specific nuances to this strategy, I won't get into all the specifics, but when you follow this strategy, leveraging a cost segregation study, right, you are able to advance, right, a good portion of that depreciation. What does that mean? So if I buy a property for $1 million and I put down, let's just say $200,000 or whatever it is that you put down relative to the loan type that you get, right? Now you own and control that asset, but then based upon the property value, not necessarily what you put down, you'll be able to depreciate a significant portion of that, which is then going to allow you to offset your income. This is really, really powerful for W-2 earners who don't have the power of business deductions to be able to decrease your tax liability, because now you can have a short-term rental business, right? Make sure you meet the requirements. I'll do another video on this, or Carter probably has already done one on cost segregation studies. So if you want to check that out on his particular show that airs every Monday, you can get to the specifics and the weeds of it. But conceptually, I want you to understand that another strategy of investing to decrease your tax liability is through real estate depreciation, right? Specifically the short-term rental strategy that allows you to do a cost segregation study. Really powerful stuff. All right, so I'm a big fan of the stock market, and another great strategy, investing strategy, right, to offset your tax liability is tax loss harvesting, right? What does that mean? It's when you sell losing investments, right, to offset the gains of profitable investments, right? So let's say that you had some shares of a particular company that you were taking a loss on. Maybe you were originally thinking about holding on to it to see if it was going to come back, but then you have another investment holding that really has some really positive gains, and you're like, well, shoot, what if I want to lock in those gains, right? If I sell my losing investments and lock in the profits for my winning ones, then I can potentially offset some of that profit, right? So if you have shares in your portfolio where you're just going to take it on the chin, it's like, hey, look, you know what? Didn't win this one. You're not going to win them all. Let me sell, right, the losers and also sell the winners and take profit. So the tax liability that I would normally experience on the profitable ones isn't as high, because some of it is offset by some of the losers in my portfolio, right? And so that's a great strategy when you, again, have very profitable investments and you're trying to offset some of that profit by taking advantage of tax loss harvesting and selling some of your investments that have taken or experienced a loss, right? Tax loss harvesting can be great for that. All right, and last but not least, and probably one of my personal favorites, is collateralized portfolio loans, right? I'm pretty sure you guys have heard me talk about being able to invest in a brokerage account, borrowing against said brokerage account to then go buy other assets like real estate or maybe private equity. Now, how is this applicable to mitigating taxes? Well, under normal circumstances, if you had investments in a portfolio, they gained a profit, and then say you wanted to buy something else, you'd have to sell that investment to get that cash to go buy the other investment, right? Which would then create a taxable event. But if you, instead of selling the investment, you take out a portfolio loan, i.e. borrow against the value of your portfolio. So you're not decreasing the portfolio value, you're leveraging its value to get a line of credit. So say you have $100,000 invested, the lending institution might give you up to $40,000 line of credit to do what you want to do, right? Your portfolio is still growing, it's still earning, which is great, right? Then you get to take that line of credit and go buy some real estate, go buy some private equity, right? But the benefit is loans are not taxed as income. So instead of having to not only sell your investments, which you no longer would have, and create a taxable event, now you get to borrow against them, keep your investments, allow them to still grow, and now you experience no tax liability. Not to mention, you can also deduct some of the loan interest on the loan that you took out based upon your portfolio value. So guys, when it comes to building wealth, when it comes to investing, when it comes to personal finance, you just have to know the rules. And these are some of the rules that I live by to mitigate taxes when it comes to building wealth. All right. Let me know if this was valuable. Please leave a comment if you like this. Subscribe, right? Like, don't just watch these videos. If you're here week after week and you're not subscribed, what are you doing? Right? Make sure you subscribe, share it with a friend, right? We're at year end, people looking for tax strategies. Make sure you share it with a friend. And let me know what you think about the views. Should I do more episodes like this, more laid back, camera a little bit further away? Let me know if you guys like it. And believe it or not, this is just on my iPhone because I'm traveling, which I don't know if that means much because most of these videos are on my iPhone or on my laptop. But nonetheless, thank you for tuning in. And remember, the quicker you get to your dream life, the longer you get to live it. Freedom is for sale if you're willing to pay the price.